Well, if anyone knows what we can expect from these test results, it's our next guest. Antonio Garcia Pascual is a former financial economist for the IMF who worked on stress tests in Washington. He's now Barclays Capital's chief Southern European economist, and he joins us live from his offices in London. Thank you so much for joining us. So I want to start by asking you how the European stress tests compare with those that were conducted in the US.
Well, that is actually the main question. I think in the US they did a great job about publishing sufficient details, and here that is what the market is actually expecting. I think it will be critical that the key exposures of the banks are revealed, in particular actually the exposures to the sovereign. And that is important because unless sufficient details on the sovereign exposures are provided, then the market will not be able to replicate the test, and that is critical. Because if, let me just add one thing. Basically, if the results, actually the information is not sufficient, then it'll be difficult to replicate, and then it's difficult then for the market to validate the results.
And there were other factors in place in the US as well, weren't there? For example, you had quantitative easing measures by the US Federal Reserve and fiscal stimulus. What did that mean for the stress tests?
Well, clearly, the situation right now is quite different than the situation back a year ago when the U.S. Stress tests were done. So a lot of the recapitalization and restructuring has already been done here in Europe. And that is why, basically, you would not expect a large impact on the systemically important banks. I think the critical element here is to understand what's going on for those banks where there is less market information, for the non-quoted banks, such as the German Landesbank and the Spanish Cajas. I think the stress test could really shed some interesting light, because there's also some restructuring processes that have been going on in these banks. So it'll be interesting to find out exactly what the stress tests tell us about this, how well they've been recapitalized and restructured.
So from what you're saying, the stress tests will be useful in some way, but I suppose that the crucial thing here is what the market reaction will be. Will it do anything to restore confidence, if not remove doubts in Europe's banks?
I think, indeed, I mean, well, if we go again by what happened in the US, actually in the US the markets were fairly good at anticipating which banks were going to pass or fail. I think in Europe already some of that dynamic has already taken place. And I would expect that the markets, are more or less right in that. I think where there will be maybe some surprises is on the size of the recapitalization that is needed. And I think here what is important, of course, is that the supervisors come up with clear and credible plans on how to recapitalize those that are undercapitalized, and that will be critical to actually stabilize the market.
There seems to be some level of consensus that the big banks, the banks that matter, are likely to pass. How significant will it be if the likes of, well, Spain's regional banks, the Cajas that you speak about, how significant would it be if they fail these tests?
Well, I mean, Cajas are important, but are mainly important within Spain. I think there are many types of Cajas. Some are in fairly good shape, some others in not such a good shape, and some will definitely have to recapitalize a little bit. The critical element for those that need to recapitalize, which will not be all of them, is what is the size of recapitalization. Okay, that is what the number actually of the capital needed will be critical. So
it's the size of recapitalization that will be key to that will have an impact on reaction in the markets. And I suppose the other concern is that, well, you have Germany, which has created this fund to help banks that are in trouble. Spain has done the same, though they have less money. They've contributed less money to that fund. What about other southern European countries which have no fund or very little funds in place?
This is true, but you also would expect less of an impact on the other southern European countries. If you look at Italy, they didn't have a real estate problem. Greece obviously has a lot of exposures to the Greek sovereign. But, if you make a stress test of Greece having a large haircut sovereign, obviously their banks will suffer. But that will go true for every country and every banking system, right?
Antonio Garcia Pascual, Chief Southern European Economist at Barclays Capital, thanks so much for joining us.